Start. Okay. So we'll start. Good afternoon again. So we'll start with the assumptions and then the calculation, good calculations. Right. So when we are doing the time value of money calculations, you have to identify a point in time is denoted by letter T, right? T means a point in time where denoted by the letter T. That means it might be number, it might be changed 1 to 10 or whatever the end, right? Then unless otherwise stated, T equals what? T equals 0. T equals 0 means what? Today, right? Today cash flow. Unless otherwise stated, all cash flows are occurred at. So cash flows might be occurred at the end as well as at the beginning. So then if it is not mentioned, we think cash flows are occurred at the end of the time period. Cash flows are treated as positive. Positive means inflows and outflows means negative amounts. Compounding frequency is same as the cash flow frequency. You might know that's one. So compounding frequency means number of time periods that you are going to have the interest, right? That is similar to the cash flow frequency. We think that cash flow is also in line with the compounding frequency, right? So these are the some of basic assumptions. Even you have not identified those things in technically, you are practically applying those things. So you all know there are two types of interest, right? So what those two types of interest are? Simple interest as well as the other one, compounded interest. What is mean by simple interest? Simple interest. You deposited money, right? So we go to the first one, simple interest. Right. Simple interest means what? You deposited money in somewhere else and then you have been allocated the interest rate. So then at the end of the time period, you will be going to have the interest based on the fixed amount that you have deposited. If it is 100, for example, right? For example, so you deposited 100, sorry, you deposited 1000 and then interest rate 10%, n equals 1 year, right? At the end of the period, what would be our interest? 1000 multiplied by 10%, that means 100, right? So what is this we call as one? Simple interest, right? Simple interest. Okay. So under the simple interest, we have to calculate future value as well as the present value. So if you have been granted the simple interest rate, right? You are receiving now, just imagine you are receiving simple interest rate. If it is so, how can you consider how can you calculate future value as well as present value in the simple interest rate condition? That is what we are trying to focus. How can we calculate? As I did previously, future value equals P0 means what? The amount that you have deposited, that you have invested, or the principal amount, that is P0, plus what is SI? Simple interest. Simple interest. How can we calculate the simple interest? We know, right? The amount that we have invested, P0, multiplied by the interest rate, right? Interest rate will give us simple interest. So then you have to add that one to P0. So this is how you can have the simple interest. Simple interest. Where SI means simple interest. SI, simple interest. Share the screen. Okay. Right. So where P0 means always at present. What would be the invested amount at present? Invested amount at present contains P0. FP we know that is future value. I means interest rate. Some of you might taken this one I as a R also. That is also okay. N means number of time periods. N. That. You can write down the formula. Done. Okay, good. So then read the question number 1 and try to do this one. Very simple question. Just try to recall your memory on what you have taught previously. And you all have taken a print out. Most of you have printouts. That means you are going through the website, that is LMS page, before you are coming to the lectures. That's the printing. So we read the question. Assume that you deposit rupees 60,000 in a savings account which pays 12% simple interest for 10 years. Right? How much can you get after 10 years? Right? How much can you get after 10 years? What would be your simple interest? Okay. So I will just do the calculation here. Normally, hereinafter, when you are starting the finance question, please summarize the question, right? So you might given lot of incidents, lot of figures, lot of numbers. Just summarizing the numbers gives some sense regarding the question, right? Okay, so then you deposited 60,000. That means P0 60,000. And then interest rate, that is 12%. Interest rate 12%, and then N equals number of years 10 years. Number of years 10 years. Right. How much can you get after 10 years? Right? How much can you get after 10 years? How can we calculate? Future value equals, you would receive simple interest, right? Simple interest plus the principal amount that you have invested, right? How can we calculate the simple interest? You have deposited 60,000. On that one, you are receiving 10% interest per annum. Likewise, you are getting interest for how many years? 10 years. Right? This should be 12. Right. Okay. So how much can you get after 10 years? 100. How much can you get after 10 years? 132. Right. 132,000. What is the simple interest then? Simple interest 72,000. Okay. The first question answer is you can get after 10 years 132 rupees. This is the answer. And then the second answer, simple interest This is how can we calculate the simple interest. This is the way. Right? So what is the simple interest accordingly? Your simple interest would be 72,000. 72,000. Are you clear? This is a basic question. What is the interest rate? You have been offered a simple interest. Are you all okay with this? Done the conclusions? Okay. Right. Now we'll go to the next part. Right. How can we identify present value of the future cash flows if the interest rate is simple interest rate? Right, again, what is this focus? How can you identify the present value of a future cash flows given the simple interest rate? Are you clear? Right. So then how can we identify what you need to identify? You need to identify the present value. So this is again what we are doing. The basic formula we have used the basic formula there. See here. This is a basic formula. So then what we are trying to do, we are going to isolate the PV here, right, from the basic formula. Very simple. So then you have been given future value. After 10 years, you will have this much of amount, right? If it is so, if the number of years is this, if the interest rate is this, how much you need to deposit today? What is reflect? Present value, right? Nothing important or nothing new here. What we have done, we have isolated the PV based on the general formula, right? Okay, so then accordingly, future value divided by 1 plus interest rate multiplied by n called as the present value, right? Present value. We'll go to the question number 2, right? Try to do this one. First, what you can do, first, read the question, summarize the information, and then come to the calculations. Okay, I will summarize the question. Suppose that the investor want to receive 2 million after 10 years from now, right? So then, Sakir, n is equal now 10, right? Then you want to receive how much? 2 million. How many years? After 10 years. Then that would be what? Is that future value or present value? That is future, right? Future value, FV. You want to have 2 million after 10 years from now. Future value. You will be given 12% simple interest rate. Therefore, interest is equal to how much? 12%. 12%. Now we can calculate. What's the question? How much should he invest at present? Present means you have to, once you see these two words, future means after 10 years means definitely write it down quickly there. That is FV. Right? Present just paid year 0 means what? Present. So therefore, at that point or the whatever the given clause there, you just quickly write it down. That is PV, right? Okay. So we'll calculate. Nothing new here. Present value equals, right? Future value divided by 1 plus interest rate multiplied by number of years. Okay. So we'll apply quickly. Future value 2 million divided by 1 is fixed and then interest rate is 0.12 multiplied by 10. What is the answer? 900 rupees, 909,909.9 or something. Am I correct? Yes, right? That means that is the amount that you need to deposit today if you want to have 2 million after 10 years from now, but the interest rate should be one simple interest rate, right? So accordingly, we'll go to our mind map. So what we have identified, the first concepts that we have identified is simple interest. Simple interest, right? Under that one, simple interest, we have calculated present value first and then future value second, or future value first and then second one, present value. How can we calculate future value? Future value equal P0 plus simple interest, present value equals future value divided by 1 plus interest into n. Okay, so we'll move to the compounded interest now, right? Next term, simple interest done, then we'll move to the compounded interest. Or compound interest, not that. Compounded interest. Compounded interest. The first task is to identify what is meant by the compounded interest. Very simply, compounded interest means interest on interest, right? Interest on interest. What happened there, right? Interest on interest. You deposit, right? So our example, Patum, right? Patum open a savings account or else open a fixed deposit, 1 million, right? 1 million fixed deposit on Sampath Bank. Sampath Bank, right? He is given, right? 10% compounded interest, CI, compounded interest on this investment, on this FD, right? This is for 2 years. This is for 2 years. Right. So now this is, this is a timeline. This is one, a timeline, right? Year 0, deposit, and then first year, second year. 1 million, deposited 1 million. At the end of the first year, definitely, Pathum can have how much of interest? 10 million multiplied by 10% interest. How much is the interest now? That is 100,000 interest. 100,000 interest. If it is a simple interest, what happen? You can collect this 1 million at the end of the first year. But what happened in this compounded interest? You have 1 million, your investment again will renew with the 1 million plus 100,000 interest. This is the interest. And this is your investment. Right? Now your beginning balance for the second year would not the 1 million. That would be what? 1,100,000. 1,100,000. Right? Then second year you would get the Pathum will have now the interest on which amount? 1,100,000 multiplied by 10%, and then what would be the interest? 110,000. 110,000 is the interest. At the end of this financial year, right, at the end of this the second year or the 2 years period, right, what would be the total interest? What would be the total interest? 100 plus how much? 110,000, right? 100 plus 110,000, how much is it total? 210,000. But if you only get simple interest, what would be the interest? 100,000 for this year, and second year, how much? Second year, how much? This is regarding the compounded interest. If it is a simple interest, that would be again not 110, it would be 100 only. 100. So then totally 200. Totally 200. Hope you have understood the concept of compounded versus and then the simple interest. Are you clear on this? Polliya mata polliya hadenawa. Okay, now, so when we are discussing about the compounded interest, we have to consider 3 types of cash flows, right? 3 types of cash flow. First one, that is single cash flow. Right? Single cash flow. CF means cash flow. Single cash flow. The other one, multiple cash flows. Multiple cash flows. The third one, annuities. Annuities. Right? Single cash flows, multiple cash flows, and the other one, annuities. Right? Annuities. What is mean by single cash flow? Single cash flow. Single cash flow. Year 0, you deposited money, right? You deposited money. This is the number of years, first one, second one, third one, right? Only first year, only year 0, you deposited money, right? And then you are expecting to have this N value at the end of the third year, right? You just give the first installment or first investment in whatever the source, right? Again, you do not have any intention to have the cash flows in this mid of the year 1 to or year 0 to third year. Just one cash flow, single cash flow, right? Multiple cash flow is different, right? You today invest 1 million. Year 0, you invest 1 million, right? You again going to have a investment on second year, that is 2 million. Third year again 3 million. Fourth year again 4 million. Last year again 1 million, right? Different cash flows are there during this time period, right? We call it as what? Not one cash flow, multiple cash flow. This is C1 cash flow in which year? CF, sorry, Pita. CF1, and then cash flow in second year, cash flow in third year, cash flow in fourth year, right? But in the particular case, single cash flow, do we have CF1, CF2, CF3, CF4? No, we don't. Only we have initial cash flow, CF0 or CF1. One cash flow, right? Annuities. Third one, annuities. Annuities means what? Same cash flow for number of years, right? You can see here 1 million, 2 million, 3, 4, again 1 million, different cash flows. What's the importance here? Different cash flow. Different cash flows during several years. Different cash flow during several years. But annuities, what's the importance or else what is the difference? Same cash flow or same or similar. Similar cash flow for the series of years. It might be 10, it might be 12, it might be 5 and likewise. Sakir. Sakir deposit 0, 1 million today, year 0, and then first year, second year, third year, fourth year, and fifth year. Sakir has a whatever the business, and then first year also he deposit 1 million, third year also deposit 1 million, fourth year 1, fifth year 1, and last year also 5 million. Sakir, you can see here the difference here, right? What is the difference? Same cash flow, same cash flow. How many years? Series of years. How many years with that? 5 years. Same cash flow, series of years, different cash flows during several years, one cash flow within the number of years. Are you clear on this difference? Single, multiple, and then the annuities. Based on the type of cash flow, the identification of present value, future value will be different. That's what I want to explain at the initial point. Right? If it is a single cash flow, identification of PV is something different. Identification of FP is something different. Right? Therefore, based on the type of cash flow, these three different cash flows, you have to identify 3 or the 6 or whatever the different calculations. So when we identify which technique to be used, what is the first step? Identification properly, which type of a cash flow this is. Right. So then we'll move to the first one. What is the first one? Single cash flow. What we are going to calculate? Future value. If it is a single cash flow, how can we calculate the future value? Future value equals, very good. Present value multiplied by 1 plus ROI to the power n, right? To the power n. Present value multiplied by 1 plus R or 1 plus I to the power n. This is the formula. If it is a single cash flow, and then you want to calculate the future value, right? Future value. So you can go to the question number 3. Try to attempt on the question number 3. Read the question and try to attempt. Miss Kema deposited 100,000 in a savings account at an interest rate of 10% compounded annually. Right? What is the question? How much can the investor earn after 10 years? Visha. Visha. Okay. Kema deposited 100,000. Right now. In savings account at the interest rate of 10%. That means today you have deposited how much? 100,000. Interest rate is 10% and this is compounded annually. N equals how much? That is N. So then you have been asked to calculate the FP, future value. Future value B equals present value multiplied by 1 plus interest rate to the power N 100,000 multiplied by 1 plus 0.1 to the power 10. What is the answer? 200. 259,374. Right. The question number 2 was, what would be the compounded interest? Actually, you can have after 10 years interest. CI, compounded interest equals after 10 years, you can have 259, 700, sorry, 374, but you have deposited only the 100,000. So therefore, the difference between these two balances is one, that is the interest actually. Compounded interest accordingly, the compounded interest is 159.374. Now we'll go to the next part. Okay. The other one, what is it? Calculating what? Present value of a future cash flows. How can we calculate? Present value equals future value multiplied by 1 divided by 1 plus r to the power n, or future value multiplied by 1 means again same future value now, so therefore directly you can get future value divided by 1 plus r to the power n. That is also same. Always the basic formula is rotated. Huh? That is what we are circulated to have the whatever the balances. Single cash flow, present value. Question number 4. Take your time, read the question and do. Mr. Dileepa need to have exactly 4 million after 10 years from now. If the interest rate is 6%, how much you have to deposit today? What is the balance? Let us summarize the question. Future value equals 4 million. Right? And then interest rate equals 6%. N equals how many years? 10 years. Right. We know present value PV equals future value divided by 1 plus R to the power n. Future value is 4 million. And then 1 plus R means 0.06 to the power 10. What is the answer? How much you need to deposit today? Today, right? So that once you will see the word today, it is what? It is regarding P, right? How much? You have to consider the PV. That is what it does. What is value? 1 million, 2 million, 200, 33, 33, 33, 579. Okay, check whether you all got the same answer. About formula of P equals PV equals FP divided by 1 plus 1 to the power n. It's formula. Both. PV equals FP divided by 1 plus R to close bracket to the power n. Right. Previous formula that we have written down, that is regarding the component that is simple interest. 2.06. Hope you all should have the calculators. Next week onwards, you have to be in the calculator. What is that? Okay. So I will give the time to eat. So then. Okay, the thing is, when we are calculating these single cash flows, present value and future values, we have some other aspect also what is seen. So we just consider only one time we receive the interest, right? For a year, we received interest for one time. But there are some cases, right? There are some cases where we can identify you will get, right, interest more than one time. For example, previously what we did, annual interest, annual, right? Or the annual interest. Annual interest means how many times you receive interest? One, right? Semi-annual interest. Semi-annual. Semi-annual interest. Semi-annual interest. How many times you are receiving interest now? How many times? This is now 2 times. 2 times. Next one, monthly interest. Monthly interest. How many times you receive interest now? 12 times. 12 times. This is 1 time. 2 times. Quarterly interest. Quarterly interest. How many times you receive the interest now? 4 times. 4 times. Right. So number of time, these number of times, right, we called as we notate those things as M, right? M, capital M or simple M. Right. So then if it is, if the investor is receiving, right, interest more than one time, we should have a method to calculate this present value and then the future value, right? The base is same, but you have to change what? Number of periods. Number of times that you are receiving the interest at a particular that time, what would be your interest rate? Right? You have to understand the basic here. We previously applied annual interest. Now you have to convert based on your number of times that you are going to have this interest. What would be the interest rate for the particular time period? For example, if it is you are paid the interest on monthly wise, it should be which interest? It should be monthly interest. But you were given the annual interest, right? Annual interest is 12. How can you calculate the annual interest into the monthly interest? Divide by number of times that you are receiving the interest. How much is it? Then your monthly interest will be 1%, right? Your annual interest is 12%, but you are receiving the interest quarterly. Tell me, what would be the quarterly interest? Annual interest rate divided by 4, that is then the 3%. Hope it is now clear, right? Annual interest rate is 12. You are receiving interest for 2 times. That means semi-annual. What would be the semi-annual interest? That is 6. Right? That is 6. Not only the interest rate, but it is changing now the number of times that you are receiving the interest also. Right? Number of times. Where we have reported the number of time, that is called N. Previously, we received interest for 1 time. Now we receive the interest for how many times? N multiplied by M number of times. Tell me, if it is 12, how many times you are receiving interest? That means 12 times you have to compound it. How many times? 12 times with the interest rate 1%. Right? If it is regarding quarterly 3, right? 3 interest, how many times you are receiving interest now? 4 times. 4 times. How can we convert that one? N multiplied by M, right? N multiplied by M. So this is what we have identified. interest divided by M as well as N multiplied by number of times. Basic is same. Just we convert the interest into the whatever the basis interest, and then we have changed the number of times that we are receiving the interest also. Are you clear on this? Okay, we'll go to question number 5. Question number 5. Read, take your time and do the calculation. So you have been asked if the interest rate is quarterly and then monthly and then annual interest, what would be the which balance? Future values, not the present value. Suppose you have invested 100,000 in a bank today with the interest rate of 12%. What would be the balance after 10 years? After means future value, future value. You have to apply this part. Then multiply by this. Answer should be 326,203. What you should do first, 1 divided by 0.12 divided by 4. That should be added to 1. That should be squared by 40. And multiplied by 4. It should be squared up to the power. To the power 4 now. I don't know whether you want. Let's transfer it. To the power. Right. 3.26. That's squared balance to the power. Right. To the power. Yes. And the answer should be different. The answer is 3.6. That here, okay? So here, straight to the power. Verification wrong. Multiply 1.003 in the whole. That's wrong. It should be that. Right? Hope you all bring the calculators in next week. Without calculators, we can't do this job. All right, so I just calculate for the first one. But it asks future, right? Okay, present value, how much you are going to deposit? That is 100,000. 100,000 multiplied by, right, multiplied by 1 plus, what's the interest rate? Annual interest rate is 0.1. But first question, quarterly interest. Quarterly interest, we have 4 quarters. And then for each quarter, we are going to have the interest. Accordingly, we are keeping this we are keeping this investment for 10 years. The answer is 326,203. Same case, if it is monthly, right? If it is monthly, how can we calculate? Right? Again, future value equals 100,000 multiplied by 100,000 multiplied by 1 plus 0.12, we are going to have now the interest for 12 months. So therefore, it should be divided by 12. 10 multiplied by 12, the answer is 330,000. 38. So these are the two balances. Clear? Good. If you have any questions, you can ask. Now we'll move towards the multiple cash flows. Now the case 1, done. Single cash flows, done. Right? So what we have additional point to write it here. Application now. Application now. M times. Right? We did that one. Accordingly, you can identify by changing M. You can calculate future value and then you can calculate present value. Okay, students, now we can go to the multiple cash flows. Multiple cash flows. Multiple cash flows. If we have different cash flows to calculate PV and FV, right? So we can calculate how? FV of multiple cash flows at a common time, at a common point in time equals, right? Future value and present value. Future value and then the present value. Future value equals, right? Future value equals the sum of, highlight the sum, right? Highlight sum. The sum, right? Of which values? Of future cash values or future values. Future values. Of the individual cash flows. Highlight individual cash flows at that point of time. Right? What you need to highlight basically the sum of individual cash flows. Right? Sum of future individual cash flows. Right? Second one, how can you calculate present value? Even you don't know these technical explanations. You did this one in thousands times in calculating NPV and all the things, right? How can you calculate? Right, again, highlight the sum of sum. That means collection, total, summation, sum. Sum of which values? Present values of individual cash flows. එකතුවක් කියන එකයි මේ කියන්නේ. එකතුව ගන්න. Right? So then accordingly, what should be the first step in calculating both present value and future value? What you have to first do? Identify the individual cash flows, right? Individual future values, right? Individual future values. Identify individual future values. Or if it is regarding present values, identify individual present values and then take the total of it. That's the second point. That's the second point. Okay, I will explain this one with the given question. Don't worry. Right. Read the question number 6. Now what happened, right? So we have an investor, Mr. Sharon. Mr. Sharon. He deposited money, right? He deposited money 50,000 in which year? in year 1. Right? Again, what happened? He goes to bank and deposited how much? 20,000 in which year? Second year. Year 2. Third day also, he go to the bank and deposited how much? 40,000. 40,000. Fourth year also, he went to the bank and then deposited 70,000. Fifth year, he go to the bank and deposited how much? 25,000. These are what? These are actually the given values, right? The amount that they have deposited. What could be the interest? Interest is 10%. We'll go to the second question. What will be the present value of these cash flows? Right? Present value of this cash. Can you draw this question in a timeline first? Timeline first. Mark these cash flows in timeline first. How many years? 0 year, first year. What is the cash flow? 3,000. Second year, 40,000. Third year, fourth year, and then fifth year. Third year cash, second year cash flow, how much? 40,000? 70? 20? 20,000. 20,000, eh? Okay, third year, 40. Fourth year, 70. Last year, 25. Interest rate, 10%. Right. What is the first task? Identify individual present values. Right? How can we identify the individual present value? Now you just remember about the present value formula. Present value equals future value divided by 1 plus r to the power 10. Right? This is the basic formula. What should be our first task? Identify which balances? Individual present value balances. How can we identify? 50,000 is the after 1 year future. How can we identify the present value? 50,000 divided by 0.5. 0, 1 plus 1 to the power. This cash flow occurred at which year? First year. So then, how many times you have to convert? One time. Done. Right? Converted to the present context. Why this is happening at the end of the first year? Therefore, n should be, for that particular cash flow, it should be 1. But second cash flow, 20,000 will occur that after 2 years. After 2 years. But you have been asked present values of all these cash flows for today, PV, at year 0. Then 20,000 will divided by 1 plus interest rate to the power now how many times? 2 times. Why? We need the cash flow at today, present value when today. So therefore, divided into, sorry, to the power 2. Right? Then third year cash flow 40,000 will occur at 3 years. So therefore, to the power 3. Why? Second year, first year, third year. We need today value. Fourth year, 70,000 divided by 1 plus 0.12 to the power how many times? 1, 2, 3, 4. 4 times. 4 times. And then fifth year, this will occur at fifth year. So then, in converting this balance into the present context, you have to compound it by 1, 2, 3, 4, 5. How many times? 5 times. 5 times. This is the step number 1. Identifying which balances? Individual balances. Step number 1. Step number 2. Step number 2, what is it? Taking the sum or the summation. How can we take the summation? After converting these balances, right? Take these balances and then add those all balances. It will give us present value of these multiple cash flows. Are you clear? Good. Yes. 150. 140. 40. 114,000. 150 around something. 105. 55. 150. 5,000. 307. 70. Okay. Did you all got the same answer? Then try to do the future value calculations. Again, draw the timeline and then try to identify the future. What is it? PH or PH. Third. Right, so we'll go to the first part then. That is very easy. What it does, present value we have identified. Now it should be the future value. If it is future value, what it does, after 5 years, what would be the future value? So then again, you have to draw the timeline. Year 0, first year, second year, third, fourth, and fifth. All right. First year, 50,000. Second year, 20,000. Third year, 40,000. 70 and 25. Eh? What it does, after 5 years, what would be the future value? That means now you are placed here. Right? Then how can we calculate future value? Future value formula. Right? Now, future value equals. How can we calculate? Future value equals present value multiplied by 1 plus r to the power n. Right? Now we have to find the balance at here. Balance at here. So then converting these values into the future context. Right? You have to convert. We'll convert 50,000 multiplied by, right, 1 plus r is how much? 0.1. To the power, how many years? 1, 2, 3, 4, or 5? Yes? Very good. That is 1, 2, 3, 4 times. Right? 4 times. Then that balance should be, take the balance here. I don't know which balance. Right? Then second one. Second year balance. First year, second year. 20,000 multiplied by 1 plus 0.12 to the power now 1, 2, 3. 3. Take the balance here. Third year, 40,000 multiplied by 1 plus 0.12 to the power 1, 2. You can do it. And then 25,000 take as it is. Take the total of it. 25,000 now need to convert, and then this is the sum. Two hundred 50,000, 225. Is this? First year, that is the virtually
7,000.
70,000. 200 zero. Then second year 620. 48,000. 37. Check whether you all got the same answers. So then we'll have a break and come discussion the annuities. Do you have any question on this? No. Then you can come back. Have a break and come at 2. Let's stop the share. Okay, can we start? All good? Okay. So now we'll go to the third category, that is what? That is annuity. Right? Annuity. Third class of the cash flow, that is annuity. Right? So we identify present value and future values of single cash flows and multiple cash flows. Both are involving sum of future individual future values, sum of future values of individual cash flows, and here sum of PV of individual cash flows. Now the next task, identifying annuities, right? Identifying annuities, present value and then the future values, right? Third task, future value and then the present value of the annuity. Annuity means before when we are entering to the discussion also we identified annuity means what? Series of equal payments or receipts during over a period of number of years, right? That means same cash flows for a series of years, right? We call it as one annuity. Right. Regarding the annuities, future value. How can we calculate the future value of annuity? Right? So A means what? Annuity amount. A. Annuity. Multiplied by actually the annuity factor. How can we calculate this annuity factor? In calculating the present value, that is 1 plus interest rate. Right? 1 plus interest rate to the power n minus 1 divided by who? Divided by the interest rate. Interest rate. Right. This is the way of calculating the present value of, future value of an annuity, right? If you deposit 1 million for a year, accordingly we are expecting to continue that amount for 10 years. What would be the present value? What would be the future value of that annuity after 10 years will be identified by the annuity multiplied by the annuity factor, right? Clear? Clear? Is that clear? Okay. Right. A means annuity. Annuity multiplied by 1 plus interest rate to the power n minus 1 divided by the interest rate. Right? So if I tell you the format of obtaining this annuity factor, first do this part. Right? 1 plus interest rate to the power n. First do this part. And then from that one, you deduct 1. Second one, after taking the net balance, deducting 1 minus 2, and then third step, divided by interest rate, right? So if you are confusing on pressing this formula at once, please apply these 3 steps. Take the square root balance and then minus 1 and then divided by interest rate. Okay, we'll go to the calculation. Right, try to do this one. Question number 7. Question number 7. Very simple, right? So what you have given, Miss Agamini needs to have a total of 500,000 in 6 years from now. How much she want to have? How much she want to have? 500, right? Now, for that, she has a plan, right? What is her plan? If she deposits 70,000, right? She is expecting to deposit how much? 70,000. At the end of which year? At the end of each. At an interest rate of 8%, right? During these 6 years, right? Will she be able to make the payments? What it does? Simply, if you deposit 70,000 for how many years? For 6 years, will you be able to cover this 500,000? Right? How can we calculate? Future value of annuity equals annuity amount multiplied by 1 plus interest rate OR to the power n minus 1 divided by the required rate of return of the interest rate. So I will apply the formula. Annuity amount is 70,000. Here in this particular question, A equals 70,000 and then I equals 8% and N equal 6. A is 70,000. You are going to deposit, right? It's like this, right? If I draw a timeline, you are going to deposit. Year 0, first year, second year, third year, fourth year, fifth year, sixth year. First year, sixth. Each and every year, she is going to deposit 70,000. 70,000. At the end of the 6th year, will she be able to collect this money? She, collect the money. Right? So then 70,000, 1 plus. So 1 plus interest rate is 0.08. For how many years, Shakir? For how many years? 6 years. Very good. Minus 1 divided by 0.08. What is the future value? Future value of this 70,000 for 6 years. EVD fusion. Yes. Second one is financial reporting. Having also. Salary 400. Like the same stem. First do this one at the 0.08 and then take the 6 card and then minus 1 divided by 0.08. That answer need to be multiplied with the 20 times. If you do not have a scientific calculator, hope it is difficult to calculate the answer. $513,550. Can you check it? What is that? $513,000. 513,000. 550. 15.303. Right. Check whether you all got the same answer. Okay. Any question on this? Good. Right. So now we'll move to the next part, calculating present value of this annuity. Right? If you deposit 70,000 for 10 years, for 20 years, or if you deposit 50,000 for 50 years, 70 years, 100 years, what would be the present value of this? Right? How can we calculate again? Annuity value is there. Annuity multiplied by 1 minus 1 divided by 1 plus r to the power n divided by r. Right? Now, what is the formula? 1 minus, see here, 1 minus 1 divided by 1 plus r to the power n divided by the interest rate, or. Same formula can be rewrite like this also. A annuity, right? 1 minus 1 plus interest rate to the power minus n divided by r. Why? This is also same, right? Taking this 1 plus to the power 1 plus interest rate to the power n to here, that might be causing for the to have the minus n. Same formula, right? Minus n ගැහුවත් එකයි එක බෙදීම එක දෙනාට. Today or tomorrow, this week, I will release your group assignment. So then how many groups you have normally? 2 groups. 1 group. How many groups? 4 groups. You have 16 members now. That means there might be 4 groups. How many groups? You didn't do any group assignments yet. Yes. Okay, you did how many groups assigned? How many groups you have? 3. Coordinators. Zakir and Sumuru. How many groups? 3 and 4. 3. 3. 4. You can form your own groups. Right? Maximum count for the group is 4. Right? So then you can form the group and then you can take the responsibility of forming the groups and then you can send me the numbers to assign the group numbers. So then I will give the task for you. Then you have number so then you can take it and explain. Right? Is that okay with you? 4 members, okay? So then form 4 groups. Right? Okay, you got the question number 8. Question number 8. Read the question number 8. Very simple. If you have identified the rationale behind this. Okay, Mr. Hassan agrees to pay for a loan by 100,000 at the end of the each year for how many years? For 5 years. How many amounts that he is going to invest? 100,000 for a year. Accordingly, how many times? 5 times during 5 years. If the interest rate is 7%, how much, right, he can obtain as his loan? The maximum capacity is 100,000 for a 1 year. So then, present value of this annuity payment will be considered as the maximum amount that the bank is agrees to pay for this particular person as a loan. Otherwise, bank is not going to give any additional money. Why? Bank can't collect this one. Am I correct? Yes. If the person is having the maximum capacity of paying 100,000 for a 1 year during 5 years, the present value of total of this 100,000 during 5 years is the maximum amount that the bank agrees to pay for him. That's the amount. Otherwise, other than that additional 1 rupee, bank can collect. Bank can't collect. Right. Okay. You can go to the question number 8. Then identified present value of, right? Present value of total annuities. Read very carefully and then take your time to do the calculation. What's the answer? Amana. What's the answer? Fahima. What's the answer? Fahima. One. They were the answer one. Fahima. What's the answer? Voice. $410,090. In calculate, I will write the formula here. Present value equals 70,000. Sorry, 100,000. Sorry, 100,000. 100,000 multiplied by, look at here very carefully, 1, right, minus 1 minus 1 divided by 1 plus r, r is 0.07 to the power how many years? 5 years. That entire answer should be divided by 0.07. The answer is 410,000 19.7 around. Then what is the maximum amount that she can obtain as a loan? He or she can obtain as a loan. That is 410, right? 410,000. The answer is 410,019. This is the maximum amount. Maximum amount that can be obtained as the bank loan. Next one again, perpetuity. What is meant by perpetuity? Perpetuity also come in under the annuities type of annuity, right? Perpetuity. Perpetuity means until the infinity, right? Until the infinity, you are going to have a same cash flow, right? That means in a long run, you are going to have a same cash flow, right? If it is so, can we have a future value of the perpetuity? If it is doesn't have a time period, we are going to invest for the infinity with the same cash flows. Can we calculate the future value? No, you can't. Therefore, only the value that you can calculate is the present value. Because why? It doesn't have a future, right? So it doesn't have a future. So then, if it is a perpetuity, how can we calculate the present value? Annuity amount divided by the interest rate. annuity amount divided by the interest rate, or A multiplied by 1 divided by interest rate, same. Perpetuity. Clear? Before the last question, an investor wishes to find out a PV of an investment which yield 10,000 in a perpetuity discount of a 12%. Find the, this should be present, present value of this perpetuity. PV of perpetuity equals annuity amount, that is 10,000 divided by 0.12. You can take the balance there. Okay. So we'll go to the last question, that is loan amortization, right? So this is a practical example of the annuity with the present value. So then we can prepare the loan amortization table. Actually, we don't need to prepare the loan amortization table manually. You can do it by the Excel sheet in nowadays by clicking the insert and then the. Okay. Anyway, I will show you the way of calculating the loan amortization by the Excel sheet also. Anyway, we'll do the calculation regarding this loan amortization. Read the question. Question number 10. Suppose you are trying to borrow 100,000 today at the 10% of compounded annual interest to be paid over a next 4 years period. Right? Equal installment payments are required at the end of each year. Determine the installment balance and then prepare the loan amortization table. Right? Equal installment. Equal installment means what? That's become a equal installment, same cash flows. Same cash flows means what? Annuity. So then the maximum that you can obtain at present is how much? The maximum amount that you can obtain today is how much? 100,000. You have been given the other details. How many years? 4 years. What is the interest rate? 10%. But we don't know installment. We don't know the annuity. So then first find out the annuity. We'll do it. And if you want, you can read the question again. Suppose you are trying to borrow 100,000 or 100,000 today. That means present value of that total annuities. Compounded interest rate is how much? That is 10%. And then how many years? 4 years. Equal installment payments are required at the end of each year. Calculate installment and prepare the amortization table. Right. Last part, amortization table. You can start the workings. Compounded interest, done. And then perpetuity can be calculated. A divided by N, present value. And then first part, second one, third one, loan amortization. Loan amortization. Right? First one, installment. PV equals annuity multiplied by 1 minus 1 divided by 1 plus R to the power n divided by R. PV is 100,000. PV is 100,000. We don't know A, but we can find out the annuity there. 1 minus 1 divided by 1 plus, what is the R? 0.01. How many years, Shakir? 4 years. Divide by this one, entire answer. Divide by 0.1. Calculate the annuity factor and tell me. Annuity factor, you divide. You divide and have the answer, right? And installment is 31,250. What is annuity factor there? Fatima. This is the answer. Anyway, I'm asking about the annuity factor. Annuity factor means this one. It is around 3 something. 3.2. Right. This balance is 3.2. A multiplied by 3.2, you will get how much? 100,000. You will get 100,000. Okay, so then 3.2 A equals 100,000. So then A equals how much? 100,000 divided by 3.2. A equals 31,250. Three point nine. 3.9. What is annuity factor? Annuity factor? Three point two. 3.16. 3.16. Below it. Okay. 3.2 then. Interest rate is how much? 0.1. This is, are you asking about this one? 0.1. Interest rate is 10%. Then that is 0. Okay, did you all get the same answer? Installment? No? What's the answer then? 2, also 3.2, and this minus 2. Okay. Anyway, what is the answer? Final answer? 30. What is the answer for the animation factor? 3.16. 3.16. And you divide the 100,000 by 3.16 and make the answer. 31,000. 31,600. 645. Okay, we'll take that answer since we are coming with the 3.16. But otherwise, when we are preparing the loan amortization table, we might have a remaining balance. Okay. You can take here instead of 3.2, better to take 3.16. Okay, we'll go to the loan amortization table. First column should be year. First column should be year, and then second column opening balance. Opening balance. How many years? Year 0, first year, second year, third year, fourth year. Right? Opening balance. And then installment. Installment. What is the installment? 31,000. No installment of the for the first year, year 0, 31,645. 31,645. 31,645 and then 31,645. Right. So then next one, interest. Interest. And then capital amount. Capital balance. And then closing balance. Closing balance. We'll name column A, column B, column C, and then column D and column E. Right? B equals, right? B equals, so B can be calculated by adding C plus D. C plus D. That means interest plus capital amount is equals to what? Is equal to the installment. Okay, we'll go to the calculations. Year 0, we do not have any opening balance, no installment, no interest, no capital. But we are going to have a 100,000 loan. 100,000 loan. Right? That means year one, we are going to have a 100,000. Right? What would be the interest? Interest is 10%. Right? Now take your calculators. Interest is now 10%. Opening balance 100,000, interest is 10%. You can calculate the interest. How much is the interest now? How much is the interest? 10,000 is the interest. How did you calculate? 100,000 multiplied by 10%. Clear? What is now your capital part of the balance? Capital part of the installment? 21,645. Right? Opening balance is 100,000. We just paid 21,645. What would be the closing balance? Closing balance 55, 3, 78,355. That 78,355 would be what? Would be the opening balance of second year. 78,355. Now, what is the interest? 78,355 multiplied by 10%. 7,835. 35.5. What is the capital amount now? Capital amount. Installment is this much. Interest is this much. Right? Installment minus interest will give us the capital amount. $23,809. 809. Now, opening we had this much. We paid this much. What is the remaining? That is 100,000 value. What's the balance? Then here point, no points. No points. Here point 5. And then 54,000. 54,546. That would be the opening balance. 54,546.5 multiplied by 10%. What is the answer? 5,454. Deduct the interest from the installment and have the capital. 4.6 or something. Ne? What is the capital amount? Salita? Here capital amount. 26,109. 109? 196. 196 neither. 190. Then deduct the capital amount from the beginning balance and have the closing balance. Tell me the closing balance. 28,054. That would be the opening balance for the last year, 28,354. Interest, 2,835.4. Deduct the interest from the installment and have the balance. How much is it? 28,354. Am I correct? Yes. Chalita. 20, it should be 28,000. So then at the end of the fourth year, we do not have any closing balance that is set off. You all want the same capital balances? Hope it is clear. Is it clear? Right.